Namaskar. This is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. At a time when the credit growth of banks in India has been languishing between 5 to 6%, the overall economic growth is sluggish and uncertain in the Indian economy. Major manufacturing sectors like automobiles are in the doldrums. Corporates are deleveraging. Private consumption is weak. Demand is sluggish. Bank loans have not taken off despite the low interest rates. NPAs are piling up and banks remain credit averse. At such a time, the finance minister, as the representative of the owner of public sector banks, has directed government-owned banks to lend generously. While she does not accept that credit growth is sluggish and says that it is too early to conclude that there is no credit pickup in India, she, however, said at a recent press conference at Mumbai that banks have been directed to go out and give credit to those who wish to borrow. She said that banks must reach out and lend, especially to the exporters, to keep up the momentum of the stimulus for economic revival of the economy. Banks have been asked to interact with the export promotion councils and industry bodies so that the credit needs of exporters are timely addressed. She then said that starting October, banks will have a credit outreach program for every district of India, like a loan Mela, like the one that she had last announced in October 2019. The finance minister has directed public sector banks to step up lending from October onwards at a time when the overall demand is weak and so is the lending by banks. In directing so, she is ignoring the state of affairs of the borrowers as well as that of the lenders, as is evident from various reports in the run-up to the upcoming loan Mela announced by her. And what are those reports that we talk about? A report in the Business Standard says that capacity utilization of the manufacturing sector in India has hit a new low now. It says that asset to turnover ratio of Indian corporates has declined to a new low of 70%, indicating a further decline, a further slippage in capacity utilization. That ratio, which is at 70% today, stood at 78% in financial year 2020. And since capacity utilization has been falling, the private sector has been unwilling to invest in capacity expansion, resulting in the lowest spend in new projects by corporates since 2010. The consumption demand is yet to recover fully even now, after the significant dip in demand in the last financial year due to the contraction of the overall economy, and that reflects on capacity addition. Companies are sitting on idle capacity and idle cash also, with no incentive to add to capacity. Though it is expected that capacity utilization will improve in the current financial year, yet the point to note is that investment in new capacity generally takes place when the ratio of assets to turnover exceeds 100%, as against a mere 70% today. So it's still a far cry away. In this situation, any rapid scale up in project term loans by banks is ruled out, irrespective of a loan Mela or not. Which corporate will borrow and add to its capacity when its present installed capacity lies idle for want of consumer demand and peak capacity utilization is still uncertain and miles away? The next indicator of the state of affairs of borrowers comes from the Financial Express, which recently reported that due to repayment defaults by borrowers, possession and auction notices by lenders are on the rise for the apartments of those who have taken home loans and they have not been able to pay and they have defaulted. Home loans are considered to be the safest for the lenders because of the security of a house mortgage and the fact that borrowers want to avoid losing their homes at any cost. Thus, they are considered to be one of the safest lendings. Auctions of homes take place after all efforts to resolve the loan have failed, including a moratorium to the borrower, restructuring of the loan, additional loans, etc. And it thus shows a marked deterioration in the asset quality of the lenders in India. Most of the defaulters whose homes are in auction today are either the self-employed or the salaried class, showing the kind of crisis which is there in that sector. If the auction of homes due to housing loan defaults have gone up, so has been the case of gold loans, where the jewelry of households is being auctioned due to failure of borrowers to repay loans. If you look at newspapers nowadays, you will see voluminous auction notices of lenders running in a few sheets. In the case of Manappuram Finance, for example, gold worth 1500 crore rupees was auctioned in June 2021 quarter, recording a threefold jump from the previous quarter, and also as against an auction of just 8 crore worth of gold during April to December 2021. That's the kind of default taking place in gold loans. Jewelry is the emotional and financial corpus of an Indian household, and the fact that their auctions have gone up shows the dire state of affairs of Indian households. Interestingly, Muthoot Finance, on the other hand, shows a different trend in the matter of gold loan auctions. While in July 2021, it put up 24,000 gold items for auction, it yet said that default cases remain within acceptable limits, with 99% of its borrowers either renewing or redeeming their gold loans. Thus, Muthoot Finance speaks something else. The fact of the matter is that indulging in loan melas at a time when the borrowers and the lenders are in no great shape and the economy has been languishing will not help and will only compound the crisis that we face across the board. Perhaps the government is pushing bank loans as a substitute for its own failure to come up with a genuine and adequate fiscal stimulus in order to provide direct financial support to a struggling economy, an economy which has taken a big hit because of the COVID pandemic. The history of loan melas in India says that they have only eroded the financial condition of the public sector banks whenever they were launched. And for that reason, and for others that we discuss below, that we think that another round of loan melas announced by the finance minister is not the right thing to do. The first reason, the biggest bane of public sector banks in India has been the meddling in their affairs by the Neta and the Babu. The government may be the owner of public sector banks, but when the Neta starts ordering the bankers what to do and who to lend, generally, of course, for political reasons, for crony lending, etc., the balance sheets of banks always takes a beating because of that. At a time when the NPAs are on the rise, recovery of bad loans is pathetic and bankers remain credit averse, the finance minister has announced a loan mela, which results in compulsive lending by the banks, with prudent and caution in lending being thrown to the winds, because that is what the loan mela is all about. The loan mela will certainly result in a spike in delinquencies and defaults in the banking and financial system, and a further build-up of bank NPAs in the coming years to us is imminent. The second issue, a bank is not a FMCG or a marketing company which sells consumer goods at a discount, which is what happens when there is forced and indiscriminate lending in a loan mela. A bank cannot indulge in a fire sale or a discount sale like a marketing company, because a bank does not sell goods, but it funds to ultimately recover what it lends, which is not quite the spirit in loan melas, as experience says. The third, banks today face a deficit of what we call willing lenders and eligible borrowers. A loan mela tends to do the reverse, which is unwilling lending to ineligible borrowers, which destroys banking culture and does little to support long-term economic revival and growth. What is needed is that viable and sustainable entities or promoters of good integrity are readily funded by the banks, for which you actually do not need a loan mela. But what you need are non-corrupt bankers who are accountable and encouraged to lend genuinely without the fear of a backlash in case their bona fide lending decisions go bad. That is the real need of the hour. The real challenge and the problem today lies that viable and sustainable entities are not getting adequate and timely funding and support from the banks, which is what is needed, and not indiscriminate loan melas, as the finance minister has announced. The larger picture is that a government which has been unable to provide any meaningful fiscal and financial support or a stimulus to revive a COVID-stricken economy and has failed to provide direct financial support to those who need it the most, has been now trying to shoot the gun from the bank's shoulders by directing them to hold loan melas and give loans. While the loan melas will not necessarily provide direct financial support to all those who need it for their survival and revival, it will, however, certainly erode the financial condition of the banks, because loans given in loan melas tend to be like populous grants which should be given and borne by the government and not by the banks in loan melas, as the finance minister has directed them to. This is Akhilesh Bhargava signing off till we meet again. Namaskar.